So by having regular trading hours, it benefits us by knowing where, if there is a opening range gap, and by knowing where we settled the previous day, that's the benefit in it. So I want you to see that for today, we had market trade higher here, and we had this large gap that has traded since 9:30 this morning. So that opening price there and the settlement price there, that difference is the opening range gap. Now I'm going to show you also by dropping into a 1-minute chart. We're going to scrub back here. And you want to do your measurements on the opening range gap with the 1-minute chart in regular trading hours. So having the open and close on this here is the same price essentially. And this is the beginning points of making money with smart money concepts. You have to have a frame of reference. You have to know where do you start? Well, if you're day trading and you're trading index futures, this is where you start. Is there a gap? We can see that the market opens up at 9:30. We now have what is described by me as the opening range gap. It's the regular trading hours difference between today's opening and previous day's regular trading hours close. That's all it's doing. Now, when we do that, if the gap is larger than say 20 handles, you can start running your fib across it, and I'll let you see my settings because I know I get asked that a lot. I'll untoggle this for now. These are the settings. So this is the lower quadrant, upper quadrant, midway point, or consequent encroachment. And then you can highlight 0 and 1, which is going to give you basically the same levels that I've already highlighted here with those black lines. So it would look like that. Okay. So we have a premium gap opening, and I'm not interested in trading long on that when it's such a large gap opening like that. So I'm going to let it trade higher. I want to see where it could likely trade to. Okay, remember we have to know how price is likely to deliver and by time. And we know it's non-farm payroll week. So we want to be trading on Monday. But we have a large gap like this. We have a tendency to do what? Keep going in the direction of the gap. But eventually in the afternoon, between 10 o'clock and 11 o'clock, we could see a change or a shift in market structure as we enter into that lunch hour. And then we could anticipate a move back into that gap, being the separation between previous day's settlement and the opening price. So the upper quadrant, that's a very important level. I think that that is a high probability draw on liquidity if the market eventually can show me that it wants to trade lower. So by knowing where the market may likely draw to before it can reverse and trade lower, those are important factors in what it is I'm trying to ascertain in price action. So I sit on my hands. I'm not interested. I'm not interested in trading this long, but I'm also not trying to pick the top either. I want to see how the market can produce a turn lower. I don't need to pick the top in that. And I want to see the market provide a time-based delivery. That's a macro. And I'll talk about macros in this lecture series and how I'm going to employ them with this model. It is not, again, it's not the panacea. It's not the be-all, end-all with macros. It's just how I arrived at a model using them. You can make lots of different models. I could make a model every single day using the macros, 365 days, and they would never be the same model. Okay, it provides you such a wonderful tapestry of applying this information on an individual and unique basis. Nobody's trading model is going to be the same. And it doesn't mean that you can't be profitable. All of you can be profitable with a different model using what I've already taught in Smart Money Concepts. So since we have the opening range gap here defined and we have all the gradient levels here, obviously moving half gap, which would be much more significant of a move, I don't require that. What's the highest probability direction that it's likely to trade to? Go below this low, because that's the lowest low of the day, at the new start of regular trading hours. That means 9:30 today. And then the next quadrant is here. So 21,672 even, to me, is high probability. That means it's likely to draw to this low and as much as that level here. And it could trade down to half, but I'm not going to require that. So what's low hanging fruit objective? Eventually trading down here. What's high probability draw? The upper quadrant, using the opening range gap. And I'll talk more about it in its own individual video, but for here, it's accomplished the method. So now what we're going to do is we're going to go up to a 60-minute chart. And I want you to look at how we have the data that's shown here. This is the opening range gap on the 60-minute chart. Again, regular trading hours. If you look at over here, we have this drop from high down to that low. This is a lot of gaps in here. So I'm going to remove all that mess and noise and go into electronic trading hours. And we're going to clean up that range. So now I can go and look at this same thing here. So we have this high and this low. So this was the old range, okay, or old dealing range. If I note this, like this, and this low here, when the market broke below this low here, the market was bearish. Now, obviously, I know there's going to be some, very cynical people that I'm never going to see the comment from. They're going to say, "Oh, it's obvious. It's hindsight." But you have to do this stuff in backtesting, studying it, get the information, see it, get used to seeing the pattern, get used to seeing the order flow, and then how the market runs for liquidity. But we can see how it was bearish here, and the market creates a low, lower low, lower low, and finally does, in fact, trade below that low here. So what was resting below that low? It's sell side. So because we are not demanding that the market created a low or long-term or intermediate-term low here to trade back above this high, we don't need to have that high broken. So all I need to know is, where is premium? Where's discount relative to now this high and this low? Why am I referring to those two reference points now? Because this range was attacked and traded outside of by these two lows here. And it's reasonable to see the price want to come back up, take out this high. What does this high form? Low, high, lower low that takes liquidity. That's a high probability ICT smart money concept breaker. It's a bullish breaker. And you can see that's occurring right there. Trades higher. And all of these buy side liquidity pools here, here, here. And then this one here has the added benefit of what to the left of it. An inefficiency in the form of a sell side imbalance, buy side inefficiency. So we can take this little area here and zoom in right there. So it's this candle, and this candle. So if we highlight that, this price, and we'll make it like that. So that way it flips a little bit. So we have this closing price to this opening price. This closing price is slightly higher than that one. That's why I'm using it, because this is a small little tiny volume imbalance. If you look at the closing price, which I don't show here, let me add them now. I apologize. The closing price here is $21,695.75, and the opening price here is $21,694.75. So there's a difference of one handle, but that's enough to create a volume imbalance. So that's why we're using this opening price and not the wick. Okay, so otherwise, if this closing price was overlapping where this price opened or candlestick opened, there wouldn't be a volume imbalance. So because there's a volume imbalance, we have to use this candlestick's opening. Otherwise, if this was lower than this candlestick's opening, it would be resting on this candle's wick high. Same thing here. This candlestick's closing price comes in at 21,894 even. You see that here. And this candlestick's open is what? 21,893.75. So it's 1/4 of a point, okay, or 1 tick. So there's a separation there. So we have to anchor the sell sign imbalance, buy sign inefficiencies labeling or overlay with the rectangle tool on this candlestick closing price. If this candlestick's closing price was lower than this candlestick's open, we would simply use this candlestick's low on the wick. So that way, now you understand how I'm going to use that information when I'm looking at SIBIs and buy sign imbalance, sell sign inefficiencies, BISIs. All of my inefficiencies are defined like that. Okay. By doing this, you're going to get the algorithmic precision of where consequent encroachment is. And you'll see what I mean in a moment. So I'm going to take this and highlight the extend to right. And that way, when we draw back out to this perspective, everything will be clear. So now we have several things in reference now. We have this inefficiency here that is inside of a premium. How do I know that? Well, we have this range low and this range high. So the market has traded between this range high down to this low. This level here defines equilibrium. And anything at that price or higher is a premium. That means it's expensive. It's a target for when you're bullish, or it's a place at which you want to use to sell short at. At this price or lower, it's discount. That means it's a target for anything that's short, or it's a place to go long when you want to be bullish. Well, since the market has worked off a bullish breaker here, it trades up. I'm not interested in going long here. Why? Because we have a large opening range gap at 9:30 opening. So I don't want to be in this market doing anything long because I want to see how it's going to trade to this inefficiency here. So we have the upper quadrant, which is right around what optimal trade entry would be. Remember the old flagship idea that I taught on this YouTube channel? So the market trades up, hits that, and then it starts to roll over. And then what I want to see is, does the market, in fact, attack after 9:30's opening? Does it attack that upper quadrant, this level here, which is part of the opening range gap? So now with this frame of reference, we know that the market did in fact trade up into a premium. We completely overlap this sell side imbalance, buy side inefficiency. So efficient delivery's been given. This one single candle down, what's it lacking? Overlapping price delivery that's on the upside. In other words, buy side is offered to the marketplace. That means a candle or candles, plural, has overlapped this entire range that's highlighted in pink. We see that happening here. See that? And then we have a small little wick outside of it, and then we break lower. And then it does, in fact, trade to the upper quadrant. It does not trade to the consequent encroachment or middle of the opening range gap, which again is defined by these two black lines here. So now we're going to drop into a 1-minute chart and flesh this out. And if you look at what we've seen today, initially at 9:30, we see the market, well, at 9:16, it dives down and does, in fact, trade to the upper quadrant of the opening range gap level, but we don't know what that level is, the upper quadrant, yet, because we have to have first the opening bell at 9:30. So that means at this candlestick right here at 9:30, you can see that that opening price is what it's laying on top of. So that's your opening price at 9:30 right there. Okay. So this upper quadrant level is not salient at this moment here. It just so happens that it does, in fact, trade down in there. Look at the bodies respecting that level as well. So I think that's a little algorithmic, but it's outside the scope of this discussion. At this point here at 9:30, then we do have the opening range gap defined by that opening price down to the previous day's settlement price. And then we have the lower quadrant, consequent encroachment, and the upper quadrant level, and then the opening price at 9:30. So this is in its entirety the opening range gap. So as I defined earlier, I'm only interested because we have such a large opening gap. It's several hundred handles. That means it could potentially keep trading higher in that direction. So you got to be real careful. It's too big of a gap. So I'm going to elect to not do anything by going long and chasing the direction of the gap. And I'm also not looking to sell short initially just to see it go down to the opening range gap and trade into the opening portion of it. I have to defer that interest until later on. What constitutes that? That means that we have to wait for it to trade up into that 60-minute imbalance. So it does in fact trade up into it. There, look at the bodies respecting it. This is a 1-minute chart. That small little deviation outside of that SIBI, and we spend some time here at the high end of it, and we start to roll over. And you can see how trading into the lunch hour, we're getting a little bit of a retracement. Notice the halfway point. This is consequent encroachment of this pink shaded 1 hour inefficiency. It's in a premium relative to the large 1 hour range. And now we're starting to work that level here. That's that midpoint of this pink shaded area. And they work through lunch like this. And then at 1:30, we start looking for the PM session trade. Now I have the market trading to the low end of that 1 hour SIBI. That's that pink shaded area here. So I've already seen it trade down below the midpoint, and then it traded back up to it. And look at the bodies respecting it. So is it indicating at that time that the market is wanting to explore anything higher? No. And at 1:30, we're now entering algorithmically the PM session or the afternoon trading. So what do we have at this point? We have the market trading up to and completing the full delivery to that 60-minute sell-side imbalance, buy-side inefficiency. Then we want to watch and see, does it move lower? It does. Does it breach the midpoint of that inefficiency? It does. Once it does that, does it show a willingness? These are all algorithmic signatures. These are indications that the algorithm that's offering price, it's not the buying and selling pressure, that the algorithm is offering the signatures proving, okay, like flashing a neon sign, like a billboard sign on a highway, that this thing is going to go lower. Don't anticipate anything in the upper range of this now, because it's already been fulfilled by this run here. And look how much time it's spent up there. So now at 1:30, the gears have now changed to now looking for the market to move lower. And now I have a trade stage where I can now engage price action. But I don't want to just simply go into it willy-nilly. That means I want to go in with something that's algorithmically timed by a macro. I want to target liquidity. I want to have a very simple entry strategy. And I want to know where it's likely to draw to, and then afford myself the opportunity to catch a runner if it wants to trade down to the midpoint of the gap or consequent encroachment, which is that blue line here. So I want to frame an idea around all those things. So let's take a look at that now. All right, so here we have the market trained in on the 250 to 310 macro time. We're trading near the low of that 60-minute SIBI. And here's that upper quadrant level on the opening range gap. And if I scrunch this up a little bit more, you'll see that the 50% level of the opening range gap is down here. So that is a wild card. I don't know, you don't know, no one knows if it's going to trade down there. But we do have a high degree of probability that it's likely to draw to that upper quadrant level. So that's what I'm focusing on in the trade idea. This candlestick, we opened lower here. The very next 1-minute candle, I want to be short. So when it opens, I want to use that open and anything that trades back into this candlestick's body or wick. So you can look at the low of that candlestick there. It's at 21,710.50. And by using that as an immediate rebalance, this next candle here, we open, we trade up a little bit. The high of that candle comes in at 12.50, and I only had basically 1.25 separation between the two. There was literally no drawdown at all from the entry though. It trades up to it, hits the immediate rebalance, and then delivers lower. So I have immediate feedback that I'm on one side. I'm targeting this level down here, but I don't want to just simply take profits as it hits that level. I want to try to get to that level and lower, because I might get lucky and see it trade to half the opening range gap. So I'm going to trade with this and watch how it delivers and move away from this 60-minute SIBI's low, which it does aggressively here. We have a little bit of retracement back and forth in here. And then finally, we have a little bit of, on this candlestick when it was breaking lower, I thought that we were going to have a pretty good chance of getting to that consequent encroachment of the opening range gap. So what I did was I rolled the stop to 21,666.50. And you can see that it does in fact hit that. And it was based on being in the upper portion of this body, so I felt if it did that, it probably would have rounded this low out and then move back up into this area and maybe trade back up into the 60-minute SIBI. And in fact, that's what you see here. So there's the entry, the exit being stopped out. And here's the entry point there using the immediate rebalance. Okay, so those are concepts that were taught in 2024. Also, they were taught in core content. So it's all throughout this YouTube channel.